Good morning. My name is Sean Dexter and I welcome you to this Mango tutorial series. In this video, we'll be discussing the difference between a moving average and a exponential moving average. We'll also be discussing what exactly is a moving average. How is it calculated? What exactly is an exponential moving average? How is it calculated differently? So with that being said, let's get in there. Alright, and here we are on the charts. We are looking at Bitcoin USD on the daily time frame, and as you guys may have noticed, I have two moving averages already put on the chart over here. The white line that you're looking at is a simple moving average, and the yellow line over here is an exponential moving average. In this video, we'll be discussing the difference between an exponential moving average and a simple moving average. I get that question a lot, and I decided, hey, you know what, let's make a video to clear out all doubts, because I think there's a lot of confusion. Everybody wants to know when you should be using an exponential, which market should you be using a moving average for, etc, etc. So why not make a video, clear out all your doubts and help you guys all out. By the way, if you guys do like this type of content, please let me know in the comments down below, and also throw it a like, because that's how I can gauge that, hey, you guys are really enjoying this type of content, and I'll go ahead and create more of these kind of videos that are more theoretical and focus more on the foundations of trading. All right, so yeah, throw a like, throw a subscribe, let me know you guys are enjoying this content, and let's get started. Okay, so in the last video I showed you guys how to set up the Mango ribbon to display the moving averages that you are interested in. Remember, the Mango ribbon is a convenience indicator that allows you to set up to 4 exponential moving averages, 2 moving averages, and a few other things related to the Ichimoku cloud as well. Currently, I have only 1 exponential moving average activated and 1 moving average activated for the purpose of this video. And again, a quick friendly reminder, the Mango ribbon is completely free. You will find a link in the description down below so that you can gain access as well. And hey, if you missed the previous video where we discussed how to set this up, please go ahead and watch it. Okay, so like I mentioned, in this video, we'll be discussing the difference between a exponential and a moving average. It is a very common question, and everybody wants to know which one they should be using for which markets. Now, that particular question is a bit misguided, and I don't blame people who are just beginning who ask that question, because there are a lot of professionals out there that say, hey, exponentials are way better for cryptocurrency, and moving averages, those should be used only in Forex. That is not true at all, guys. That's like saying, hey, a hammer is really better than a screwdriver. No, it's not. One's not better than the other. They're just made for different purposes. Similarly, an exponential moving average is made for a different purpose, and a moving average is made for a different purpose. Now you might be asking, what are their purposes? Well, let's first start with figuring out what exactly is a moving average and what exactly is an exponential moving average. Once we understand that, their purpose will come very intuitively to you. All right, so let's start with the moving average over here. This white line over here is our moving average, also referred to as a simple moving average. It's the same thing, okay? Most of the time, 99% of the time, if you ever hear someone refer to a average line as moving average, they are referring to a simple moving average. Okay, so now we know that this is our simple moving average over here, but what exactly is it telling us? Remember how we like doing it in the Mango community, guys. We like deriving a story from the indicators. We don't just trade them blindly. We just don't look at the indicator and be like, okay, that is a resistance line. Okay, that is a support line. We like to derive a story based on what the indicators are telling us. That's what the indicators are there for, guys, to help us understand the psychology of the market. So what is this particular simple moving average telling us? Well, we know that each time a new candle is printed on the chart, this line extends, correct? Each time that line extends, it's telling us the average price of the market of this Bitcoin USD chart going back a few candles. So currently the average price today on the 19th of March going back a few candles is around 5,724. So now you might be thinking, Sean, how many candles back, right? Are we talking about just these candles over here? Or are we talking about all of these candles that I can see? How many candles is this line calculating? What exactly is it taking to derive that average? If you guys go back to your school days, you guys know how we calculate averages, right? We'll have many data points, many data points, and we'll take all of them, all of these numbers, okay, add them all up together, and then divided by how many ever numbers there are. So there's 1, 2, 3, 4, 5, 6, 7, 8. Okay, 8. So we'll add all of this up and divide by 8, and we'll get our average, right? That's how this is being calculated. It's the same thing. The data points over here is each candle. We have 1, 2, 3, 4, 5, 6, 7, 8. How many candles though? How far back do we go? This is where your period comes in. You guys might have been wondering, what does the period mean when we're looking at a moving average? What does the period mean when we're looking at any indicator for that matter? That's what that means, guys. So over here, if you go to our white moving average over here, it says moving average 1. Go on over to your inputs on your mango ribbon, and you'll see that moving average 1 is set to 10, right? What does that mean? That's exactly what we're talking about here. The number of candles, the number of data points, we are going backwards. So over here we are going 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What does that mean? It means we're taking the average of these guys over here. Interesting. Now you guys might be wondering, Sean, is that fair though? Don't we have an outlier over here? Isn't this candle throwing the average off? If you think about it, let's say we have a classroom of around 10 students and we want to calculate the average height of the students, and in that classroom we have one giant, a giant who's around 10 feet tall. So you have the rest of the students around 5 feet, 6 feet tall, something like this, and then you have one giant outlier who's around 12 to 10 feet tall, something ridiculous, and then you calculate the average of the class. Are you actually getting the right data? No, right? No. That's where you need to know how to fine-tune your moving averages accordingly. So in this situation over here, we are calculating for our 10 simple moving average. Remember, this white moving average over here is a 10 simple moving average. We are calculating the average that is including these guys over here as well as these guys over here. So we are including this candle. What if we did not want to include this candle? How do we go about doing it? Well, one simple way of doing it is to simply look back only the past week, okay? To look back only 7 days. So let's go ahead and do that. Let's clear the chart out for now, okay? And let's go ahead and change the simple moving average from 10 to 7, and let's see what happens. Okay, look at what it's doing right now. Okay, look at what it's doing right now. It's all the way up here at around 5,724. If we look back only 1 week, how does that change? Ooh, interesting. So what is this telling us? Before, it looked like the 10 simple moving average, or this simple moving average, when you do calculate this outlier event, it was resistance, right? It was above price. Now, this simple moving average, if you only look at the past week's data without this outlier, the story sort of changes. This over here is telling us that, price has now taken over the simple moving average, the average price over the past week. Price is now higher than the average price over the past week. That's how we are getting our story now. That's how we can be like, things may be beginning to turn around. How's it going, guys? So this is going to be a quick update that I'm likely going to put into the middle of the video. So yesterday, while I was recording the tutorial, we were talking about this simple moving average that was initially a 10 simple moving average, and we changed it to a 7 simple moving average, correct? And the reason we did that was because we wanted to, one, disclude this potential outlier event, this big red candle, and two, we wanted to know the story of what was going on over the past 7 days of price action, over the past weeks of price action, right? So then, right after switching it, we noticed that this simple moving average over here, this white line, turned from resistance into support. What did that tell us? That changed the story, right? That told us that price was now living above the average price over the past week's price action. That gave us a bullish bias, now changing the story a little bit, telling us, hey, maybe things might be turning around. And if you guys are in the Mango C program and have watched the entire candlestick analysis module, both the modules on candlestick analysis, you guys would have noticed this candle over here too, and noticed that, hey, this is bullish too. Combined with all the other techniques that we learn in our programs, in our daily videos as well, we knew that, hey, this is likely going to move to the upside, right? And we took this trade. If you guys are following us on our daily videos, now, did we know we were going to have such a strong move to the upside? This was a very strong move, a good 30%, 30 to 35%, depending on where you caught your trade, right? You're not always going to get something like this, but the reason I am putting this over here in the video is to show you guys the power of understanding your indicators. Far too many people simply trade them blindly, not knowing what the indicator is actually telling them. If you understand your indicator, if you understand what it's actually telling you, you'll be able to fine tune it to get the story that matters. And over here, the story that mattered was, how is price behaving over the past week? And this candle over here, closing above the 10 simple moving average, was very telling. And what do you know? Surged up to the upside. And where did we find our resistance? On the next major exponential moving average that we use on our Mango ribbon by default, the 21 exponential moving average, right? So trading can be simple if you do it the Mango way and understand the real foundational concepts, and those concepts can give you an edge and also protect you from taking severe losses. For example, right over here too, right, this slope where it turned aggressively to the upside yesterday was very telling as well. But hey, I don't want to get ahead of ourselves just yet. Let's get back on over to the video, and I hope you guys enjoy the rest of this tutorial. Also, we are seeing that for the longest time, the angle of this moving average, and we'll be talking about this in the later videos coming in this tutorial series on moving averages and how to use the Mango ribbon in general. We are seeing this go downwards, right? Let's say again, we are calculating the height of our class over, let's say we are teaching a class for around 10 years, okay? And over 10 years, we're calculating the average height each and every year. And we notice that, hey, the average height is going down. Every year I'm getting a new batch of students. Those 10 students, initially the average height was around 7 feet, then the average height became 6 feet, then they're becoming 5 feet. What the hell is going on? Why are my students getting shorter? Okay, you're getting a story of what is happening. Over here, we're seeing that, hey, so in our classroom, the slope was down, right? Over here, we're seeing, hey, the slope is going down and down and down. This entire period, actually, you could see the slope going down. Now, over the past 7 days, the slope has now suddenly jutted towards the upside. Okay, so this is one way to counter a outlier event like this. But you have to be very careful to check your biases and to make sure that you're not simply changing the period to fit your directional bias. So let's say you want to go long, you want to be bullish on this asset, and then you keep changing the period, right? Currently we change the period to 7, but that's a little okay, right? Because it is valid to say, I want to look at the last week's moving average, I want to look at the last week's average price. But even then, guys, there is a bias involved. Is it fair for us to be excluding this? How can we in another way counter this? Well, another way is to simply increase the period to smoothen out the data. So in a classroom of around only 10 students, it is very likely that one really tall giant will skew the data. But let's say we had around 20 students, 21, 30 students, right? Would one tall guy really change things that much? Yes, he would have an effect, but perhaps rightfully so, okay? What if we had 200 students? Okay, now you guys are beginning to understand why that 200 moving average is so important. It's essentially calculating the average price of the past 200 candles. So if you're looking at the daily time frame like we are right now, it's calculating the average price over the past 200 days. What does that mean, guys? 200, okay, divided by 30, what do you get? You get around 6-7 months. So it's telling you the average price over the past 6 months. Okay, so that's a lot of data points, so you know how well the price has been moving, either upward directionally or downward over the past 6 months. So currently, let's go ahead and hide all of this. We can go ahead and check out the 200 moving average. We have it right over here, MA2 200. Under style, we can check out the color that we want. We'll keep it as a nice strong red, and you can see that, hey, the 200 moving average has been pretty flatlined on Bitcoin for this entire duration, always since October, since today. Okay, now keep in mind, guys, we are taking data points over the past 6 months. So the current price is not going to have as much of an effect on this moving average as all the data points put together, right? And that's exactly what long-term trend traders want, right? What long-term investors want. They want to disclude the noise of the current price. They don't want one or few outlier events to affect their investment decisions. They want to know how has this asset been behaving over a long period, which is why when you're looking at the 200 weekly moving average, it's even stronger. Because what is a 200 weekly moving average calculating, guys? It's essentially in a year, how many weeks do we have? We have 52. Let me go ahead and pull out my drawing tools again. We have 52 weeks. Okay, so around 50 weeks. So if you go 200, I'm doing maths with you guys here, 200 divided by 50, what are you getting? You're getting 4. This cancels out to 4. That's 4 years, guys. So you are actually calculating, when you are looking at the 200 weekly moving average, what are you looking at? You are looking at the past 4 years data, 4 years price action, price points, and getting the average of that. And the more data points you have, the stronger is the meaning and stronger is the story, and as a result, stronger is the resistance or the support, depending on where price is actually resting. But here is the big question. Is it fair? Is it fair for us to simply smoothen out all the data and disclude this event over here? Now, some of you might be saying, yeah, it's fair. This could just be an outlier event and we may just simply start popping back on over to the upside, and this should have been ignored. But what if this is not an outlier event? What if this is a big change in how price is going to move? How do you tackle that? That's where your exponential moving average comes in as a tool. Remember, guys, one is a hammer and another is a screwdriver, or whatever different analogy you may want to use, but they have different purposes. When we're using a simple moving average, we are simply looking at the past few candles and getting an average, right? Over here, we're looking at the past 7 candles and getting an average of around 5,290. And why are we looking at the past 7 candles? Because we wanted to disclude this possible outlier event that may turn out to be just a one-off event. But what if we wanted to be a little less biased? Okay, just wanted to check our biases in a more objective way. How do we counter that? What if we wanted to say, you know what? I want to include this candle. I want to include this candle in my average, but I also want to account for the situation that this may just be an outlier event and things may go back to normal from here. So essentially what you are saying is that if this is an outlier event, the more recent price data is going to start getting back to normal, right? Things are going to start getting back to equilibrium. So essentially, you want to say, I care more about what is happening in the more recent price action than giving importance to this candle over here. Let me go ahead and get my drawing tools. You're saying, I don't want to give too much importance to this candle over here in isolation, but I do want to include it. But what's more important to me is what is happening in the more recent price data. So if the most recent price data starts trending again back on to the upside, that's more important to me. And that, ladies and gentlemen, is what your exponential moving average calculates. Okay, going back to our example of the classroom, when we were calculating the average, what were we doing exactly? We were taking every student, okay, and then calculating their height in average. Okay, every student had equal importance, so the first student over here had as much importance as this student over here. In an exponential moving average, what you would do is you place more importance on the students who are most recent. So this student over here is going to have less importance in the averaging than this student. The more recent the student is, let's say you're calculating the student's average height as he enters the classroom, right? You're calculating the average height of the classroom as each student enters the classroom. So the student who entered first is going to start losing importance in the average calculation compared to the students who are entering most recently. Now, you might be wondering, Sean, why would I ever do that? I don't know, man. Just go with the example, go with the analogy. Think of each of these students as candles. Okay, so over here what's happening is that in this exponential moving average, right now we're calculating a simple moving average, but if this were an exponential moving average, and we'll go ahead and show that very soon, we would be placing less importance on this candle over here compared to this candle. So this candle, the most recent candle, is going to have the most weighting on the average compared to the past candles. So if we are looking at a 10 exponential moving average, the 10th candle, which would be, I think this candle over here is the 10th candle, this candle would have the least importance, while this candle over here will have the most importance. Okay? And if you think about it, what story does that tell you? What story does your exponential moving average tell you better than your simple moving average? Let me go ahead and clear this out over here for a second. And I want you guys to just think about that for a second. If we are putting more importance on the current candles more than the previous candles, we are weighting more importance on the current price action. What does that tell us? It tells us the story of the current momentum shift in the market. All right, so let's go ahead and play around with these moving averages over here. I do believe this is a 7 simple moving average, and this over here, the yellow line, is the 21 exponential. So let's switch them both up to exponential moving averages. Okay, I'm going to switch the 21 into 7, and we'll keep the simple moving average as 7 as well. And before I do that, I want you guys to just play around with this in your head for a bit. Where do you guys think the exponential moving average will come? Will it be lower than the white? Will it be higher than the white? Will it be equal? And this, by the way, is where a lot of traders get it wrong. Even intermediate to professional traders that I come across, they always refer to the exponential moving average as the more aggressive moving average. And that's not the right way to be thinking about it. Because if the exponential moving average was the more aggressive average, then you'd expect this to move aggressively down faster than this simple moving average. But that's not going to be the case, because if you look at these candles over here, the past 3 candles, they've been moving up for the most part. They've been closing green and trending up. So this exponential that we're going to show very soon is likely going to be higher than the simple moving average. It's going to be less aggressive because it's putting more weight on the more recent price action that is closer to the previous price action before the outlier, while the simple moving average is placing as much weight, guys. It's placing let me delete everything here. It's placing as much weight on this candle and these guys over here. They have equal weighting, but the exponential is doing the opposite. What it's doing is it's exponentially putting less weight as we go back into the candles. So this candle over here, 4 candles ago, 3 candles ago, whatever it be, has 3 exponentials less than the most recent candles. Okay, so my prediction is going to be that this 7 exponential moving average that we're going to switch to very, very soon is going to be higher than the 7 moving average candle. Let's go ahead and switch it right over here. And what do you know, right? So it makes sense though, guys. It makes sense. And this is where you can set yourself apart from other traders who are too mechanical with everything. You can be mechanical with how you execute your trades. Yes, that's good, because once you have a plan, you have to execute. But when trying to get the story of what the charts are telling you, to derive a story, it is very important to know what your indicators are actually trying to tell you, guys. And many people get this very simple concept wrong. An exponential moving average places more weight on the more recent price action while still giving you an average of the price that you're looking at, the date period that you're looking at, right? A simple moving average does that as well, but gives equal distribution to every single candle. So how do you use your tools? When do you use the tools? Depends on you as a craftsman of the charts. And don't get me wrong, this can be very subjective too. Changing your period to suit your bias, changing it to moving average to exponential, it can all be very subjective, and you have to be careful with that. And it's one of the reasons, guys, why I started with pure trend analysis in the Mango C program. If you guys are in the Mango C program, some of you guys ask me, Sean, why aren't you teaching exponentials and Ichimoku to start off with? It's because of this. It's because of the subjective nature of moving averages and how you can manipulate it to serve your bias when you are looking at the straightforward rule sets that I gave you guys in the Mango C program for a trend identification, break of trend, trendless situation, all of that. There is nothing subjective about it. You can be very objective and protect yourself, and then you can use these tools to get confirmation for your direction, right? That's how you do it the Mango way. That's how you do the stress-free way. So in this video, we covered the difference between a moving average and an exponential moving average. In the upcoming videos in this series, we'll be going over other concepts like what is a weighted moving average, the golden cross, concepts within the Ichimoku, and also how to use these moving averages the proper way. And if you guys are in the C program, you guys will be getting access to the strategies videos that will be coming up very soon, that you can use in conjunction with the other modules in the program to increase your edge, increase your profitability in these markets. That being said, I really hope you guys enjoyed this video. If you did, please remember to throw it a like and leave a comment letting me know in the comment sections down below, because that's how I gauge that, hey, these videos are something you guys want. These are the kind of videos I need to be creating more often. So yep, let me know and I'll go ahead and create more videos like this. Until then, guys, I'll see you in the next video.